Wall Street top investors watching your money this week. Joining me right now is Mahoney Asset Management CEO Ken Mahoney, Michael Lee Strategy founder Michael Lee, and Bolte Capital Markets chief strategist Catherine Rooney-Vera. Great to see everybody this Monday morning. Thank you so much for being here. Kicking it off with you, Michael. We got a big week for earnings. Tesla will report its first quarter results after the closing bell tonight. 10 Dow components are set to report this week, including technology companies, Facebook, Apple, and Amazon. What are you expecting from the quarter, and do you think we'll get guidance for the rest of the year?
Yeah, hey, Maria, we are entering the meat and potatoes of earnings season. Over a third of the S&P 500 is going to report this week. Analysts on December 31st were expecting a 15.8% growth rate for the first quarter. So far, as of last Friday, we've been tracking at 33.7%. So more than a double. I expect we're going to see a lot more of the same this week. And what you just said, I think, is the most important part. We're going to get some very good earnings, but what does the guidance look like? So we're going to hear from Ford. So what does Ford have to say about the semiconductor microchip shortage in order to be able to build cars? Because I'm not sure how many people realize there's a shortage of cars right now because production's offline. What else are we going to hear about issues in the supply chain and cost pressures? I think we're going to get some great numbers out of Microsoft and Google in relationship to the cloud. I think we're going to hear some great stories about internet advertising through Facebook and Snapchat and possibly even Twitter. And then we'll see what Chevron has to say about the energy sector and do they see this bounce back in energy prices and earnings continue. So I think this is going to be one of the most spectacular earnings quarters. I think analysts have continuously been wrong coming out of this pandemic. They've been far too bearish, and they've underestimated the snapback with which this economy is growing. And I think we're going to see a lot more of the same. And I would expect coming out of this week, we're going to see estimates for the S&P 500 earnings for the rest of the year much higher.
So you do think we're getting guidance then? You know, it was hard to get guidance during 2020 with the pandemic. Are you hearing guidance for the rest of the year from these companies, and do you feel like they've got a little more clarity in terms of where things are going?
Look, I think these companies have a ton of clarity. Maybe they can get away with this quarter without giving any guidance because we are still coming out of this pandemic. But next quarter, the second quarter, will be the top comparables, right? So where the second quarter of 2021 versus 2020, that's going to be the easiest year-over-year comparison. It'll be interesting to see how many companies do come out with guidance, but at a certain point, you can't keep playing this pandemic cloud or this pandemic card to hide yourself from giving forward guidance. So hopefully we'll see a lot more of it here. We get some more clarity, and I'd see analyst estimates coming up for the rest of the year.
Catherine, we will get clarity on the tax proposals this week. President Biden will detail his new tax proposals. We're expecting during his first speech to a joint session of Congress this Wednesday. The president plans to raise the capital gains all the way up to the highest earner rate of 39.6%. You add in the Obamacare surcharge, that takes you to 43.4% on capital gains tax, a rate that the Wall Street Journal is calling the dumbest tax increase yet. Larry Lindsey saying that you're not even getting the revenue that you want in that kind of a tax rate. So it's sort of a punishment to the wealth. Your thoughts on the impact of that tax should it go through?
Sure, that tax is going to have a major bite, especially in combination with the increase in corporate taxes. That is bound to happen, if not to 28 to 25%, all to happen likely through the process of reconciliation by the end of the summer, for which the Democrats need just a full 51-person simple majority in the Senate. So that's likely to happen. We're going to see increase in corporate taxes, an increase in the top marginal tax rate on the wealthy, as well as cap gains, not to mention the death tax. So we have a lot of taxes in the offing. And as Mike said, this is a phenomenal year, but it's a phenomenal year in great part because last year was so horrific. So yes, earnings are 30% higher year over year. Second quarter, they're going to be phenomenal as well. Economic growth is going to be spectacular because last year we were shut down. So the real bite of these taxes, Maria, is going to be felt next year. And this is a massive disincentive both to private investment and to the investment in the capital markets. This is what we least need right now, and it's clearly a redistribution of wealth, which is what this administration is a major proponent of, not to mention what we call modern monetary theory, MMT, which is, I think, so detrimental to the economy. In terms of investment strategy, there are ways to play this, Maria, and this is something I've been telling our clients for some time. Must have a barbell strategy. Things are looking very rosy this year. That's not something that we expect to remain. Be defensive, buy inflation puts, buy alternatives, which are venture capital, private equity, commodities, buy green energy. Almost half of the infrastructure bill goes to green energy and Medicaid expansion. So those are attractive entry points right now. And then go into tips and gold and consumer staples, which I think are cheap enough now to warrant a second look at investment by investors in 2021, preparing for a rollover, I think, in expectations and in economic growth going into 2022, particularly due to the nasty bite of this huge tax hike on wealth generation.
Yeah. What about inflation, Ken? We're standing by this morning for March durable goods orders. It's out in about 90 minutes' time. We'll also get the March personal income and consumer spending out on Friday. But we are clearly seeing an economy recovering. Does inflation come along with it?
It certainly does, Maria. And actually, we have to take it back to last year around this time when we had Goldilocks saying things are too cold and, prompted the Fed to put Fed fund rates at zero, asset purchases, stimulus, and so forth. Now, fast forward to this year to Goldilocks once again, we're getting too hot. I mean, you saw a PPI number, then you saw the CPI number, and there are ways for investors to play, and I don't think they're looking at this. I think they're really underweight in areas such as materials, such as energy. Gold is not the hedge anymore, obviously. We've had a good whiff of inflation here, and gold is still going down. I would actually recommend to your viewers to take a look at XLB, which is materials. They own companies like Dow Chemical. They own companies like DuPont. And again, that's going to rise with inflation. Energy also, XLE. There you'll find Mobil and so forth. So, yeah, we are tipping towards that. And, Maria, really, if you look at inflation, there's different types of inflation. So there's asset inflation. Check. Okay, that's real estate. We see that going in asset prices. Wage inflation, check. It's hard to get people back to work. When you get people back to work, you got to raise prices, raise wages. Oh, and then prices, yeah, look at CPI, PPI, and forward guidance into those. And you're going to see we're going to have a whiff of inflation. And again, investors better be prepared for that.
Yeah. So, I mean, the question is, do you want to invest in inflationary items like, away from stocks, maybe those companies that have more pricing power than others? What's the strategy if, in fact, we do see inflation then, Ken?
Well, we are going to see inflation. There's no doubt about it. And look, some individual investors may want to go after company name specific. We'd rather do the ETF and take the whole basket of materials, take the whole basket of energy is really the way we like to play, Maria, because we definitely understand that inflation's going to brew here. Look, we just passed a stimulus that hasn't made it through the system yet. Infrastructure spending is going to be coming, probably not the 2.2 the president's asking for, but somewhere around $1 trillion. That's a lot of money sloshing around. And it needs to go somewhere. So, to your point, real estate, materials, energy, all those type of inflation hedging, at least bring it up to equal weight in your portfolio. And then again, we see more numbers coming in like this, then you could add incrementally to those positions. So right now we're equal weight, but if more evidence comes in of inflation, we're willing to increase those positions.
All right. We'll talk more, everybody. We've got a big week ahead, and I know that there will be more items to discuss next time. Ken Mahoney, Michael Lee, and Catherine Rooney-Vera, great to see you all this Monday morning. Thank you so much. Much more ahead this morning.